Well, hi, everybody. Thanks for joining us today. My name is Jennifer Cords. I'm one of the founding partners here with Cedar Cove Wealth Partners. And we, prior to COVID, would always host these economic updates in person. And without fail, every time we did a winter event, there would be a snowstorm. So wouldn't you know it, COVID has helped us out here, but hopefully you're tucked in for the evening and are staying safe. Before we get started with our economic update, we have a few announcements and updates from our team. What we'd like to do is also remind you that if you didn't get a chance to submit any questions before our event started, there's a Q&A feature at the bottom of your screen. So feel free to send in any questions that might come up during our presentation. As a reminder, we are in webinar format. So although you can see and hopefully hear us, we can't see or hear you. So feel free to multitask, but any questions that you do submit will only be able to be seen by us. If that technology doesn't work, you can try the chat function, which we'll also be monitoring, or you can also email us at team@cedarcovewealth.com. So would like to start with a few updates. Our team is pretty good about sending communication, but one of the communications we've recently sent out is about the 2021 tax form. So it is that time of year again for the tax forms. And for those of you that maybe are unsure if you've received all the tax forms, we've put on our website, cedarcovewealth.com, under the blog, 2021 tax information. So there's information and instructions to double check if you have your forms from Fidelity, from Thrivent, as well as some frequently asked questions. Of course, if there's any questions that aren't answered, feel free to reach out to our team. Also want to note that there are some accounts from Fidelity that are non-qualified accounts or non-IRA. There is typically a bit of a lag with those tax forms. So if you log into Fidelity and have a non-qualified account, it will share with you at when that tax form will be available. So we're anticipating later this month. The next update we have for you is a client appreciation event. So we're super excited. COVID has really put a damper on our appreciation events, but we are going to be hosting a shredding event. So for those of you that have maybe already started digging into taxes and found many documents that maybe could be shredded, hang on to those. We are going to do a shred event on Saturday, May 7th from 10 to 12. It will be at our office in Bloomington. And we are partnering with a company called Shred for Good. So they're an organization that will bring a giant truck that will shred your confidential documents right on site. We're partnering with an organization called Foster Together Minnesota. And that's the charitable organization that we have decided to honor in honor of Foster Month, which is the month of May. So look for more information on our website as well as emails. But the event, if you are so inclined, we'd love to have you bring a donation, either in the form of gift cards or financial gifts, or we're putting together these fun family backpacks that will benefit the organization. So more information to come on that. And then lastly, we have an announcement that our team is growing. So we are really excited to announce that we are in the process of hiring 3 new teammates for Cedar Cove that will support our investment and our financial planning teams. So as we onboard these new teammates, we will be excited to introduce them to you. I'd like to turn it over to Ben Johnson to provide some tax updates.
Thanks, Jen. For those of you who I have not met, my name is Ben Johnson, one of the founding partners at Cedar Cove Wealth, and wanted to take a few minutes to just update you on things you've heard in the news about tax legislation that has or has not passed. So we can actually start with the headlines from the tail end of 2021. Build Back Better was proposed legislation that was gathering some steam. It had been passed in the House, but it has stalled out in the Senate, and for all intents and purposes is dead, a dead bill. That being said, there's lots of speculations that some of the core elements of the bill will get passed in some shape or fashion at some point here in 2022 or on the horizon. But with that, all we're projected here are things that actually have changed in 2022. The first would be for charitable giving. Part of the CARES Act in 2020 allowed people to deduct a much larger cash contribution up to 100% of their AGI. That's a wonderful provision for the charitable people. That has set back to its previous provision here in 2022 of 60%. So for those of you giving large cash donations to public organizations, this is something that we will help you keep your eye on. Another change you may have noticed would be Social Security benefits have increased. That's good news. The bad news is because inflation has been pretty high. In fact, the Social Security increase is just shy of 6%. It's the largest increase we've seen since 1983. In fact, the average over the past decade has been 1.65%. So for those of you receiving Social Security, you're noticing a higher amount. Also, the calculation that determines what is your required minimum distribution when you're over age 72 and beyond has been updated. People are living longer, and as such, the IRS has extended their tables to account for longer life expectancy. The byproduct of this means your RMDs are just slightly less large than they were under the previous rules. And as always, we at Cedar Cove help stay on top of your RMDs for the accounts that we are managing, and will help ensure the correct distribution goes out the door in conjunction with your tax professional. A couple other things that have been updated for 2022. Retirement plan contributions, particularly 401ks, 403bs, SEPs, and Simples. You're allowed to put a little bit more into those as contributions each year. So a good takeaway would be if you are actively contributing in an employer plan, you may want to look at how much you're putting away to determine if you should increase your contribution percentage to ensure that you're max funding. It's also worth noting that catch-up contributions, this is the extra amount you can put in when you're 50 or older, those remain unchanged from previous years. Also below, some of the income phase-out limits for contributions to IRAs and Roth IRAs have gone up a little bit. And one other thing we can point out for those of you who are paying attention to the Build Back Better news, which again has not passed, there was some speculation that the backdoor Roth IRA strategy was going away. That has not been passed into law. So if you've been working with us to do backdoor Roth contributions and conversions, we will certainly continue to have discussions with you about that to determine if that's appropriate for your plan. We will keep you posted as we learn more, as always, in this ever-changing tax landscape and environment. But now let's pivot to probably why you're here, is to hear our economic update and market outlook. So it's my pleasure to introduce to you our Director of Investment Research and Operations, Keith Sapp. Take it away, Keith.
Thank you, Ben. Appreciate that. Well, it's certainly been an interesting start to the year, and I think the timing of our pre-scheduled economic update could not be better. So with that, the agenda for this portion of the presentation is going to start with just a high-level overview of portfolio construction and how we think about long-term themes. Then we're going to jump into some of our short-term 2022 considerations, and then really just take a quick snapshot of what's happened so far in the first 6-7 weeks of the year. Come on, mouse. Sorry, there's a little delay with the clicking. All right, so starting with portfolio construction, on an annual basis, we go through and we revise what are called capital market assumptions. Our capital market assumptions are forward-looking 10-year projections of both expected returns and expected volatility across all major asset classes. Now, there's a lot of information on this chart, but essentially we break things down into 3 categories: equities, fixed income or bonds, and then real assets. And without getting too much into the details, there's 3 key takeaways that I want to leave investors with today. The first is that when you look at return expectations, sort of that middle column of numbers, you'll notice that most of them are maybe lower than you would expect. And that's true because they are lower than long-term averages. Using the US as an example, that's the lowest rate we've projected on a forward-looking basis since 2003. Turning our attention to fixed income markets, if you focus on the investment grade portion of those numbers, so US bonds, muni bonds, global bonds, and dynamic bonds, the key consideration and the key headwind that has been troubling markets year to date is that our projections on a nominal basis are positive, but when you account for inflation, real returns are expected to be negative within the fixed income space. Certainly something we are aware of and weighed heavily as we've looked at the changes we made to our portfolio allocations this year. And then finally, the word du jour being inflation, real assets being what we consider to be one of the most effective hedges in protecting purchasing power, our real asset exposure continues to serve a pillar within our portfolio construction process. Returns in that space typically are associated with things like REITs, infrastructure, commodities, gold to a certain extent, energy to a certain extent, things of that nature, where the ability to pass price increases through to the end user is fairly easy and done on a regular basis. So within that space, we've seen our adjustments for inflation rise about 0.7%, and in turn, that's impacted our real return expectations. So with that, let's pivot from our long-term outlook to some of our more near-term, short-term themes for 2022, what we're calling the playbook on how to navigate 2022. So at the top of everyone's minds, or at least maybe it was a couple months ago, is the notion that COVID is moving now from a pandemic to an endemic status. I think the most easy way to think about that is back in 2020, when vaccines were just coming out, our only immunizations were from people who had been affected, compared to now where we have almost 4 billion people who've received the vaccine and several billion people who've been infected naturally. And so it just creates a better opportunity for the economy to continue normalizing and for restrictions to continue to be relaxed. Certainly a consideration we weighed heavily again in portfolio construction. Probably the most evident theme year to date is what's going on with policymakers and the adjustments that central banks have been considering. Over the course of the pandemic, central bank balance sheets expanded to $36 trillion. And what we've seen in the first part of this year is discussions and investor positioning trying to anticipate how the unprecedented fiscal and monetary accommodations are going to slowly be unwound. And so that is certainly not an easy task, particularly given some of the other elements that we're considering, which top of mind would also be inflation. So when you think about inflation, the question last year that I think a lot of us probably got wrong was, is inflation transitory or not? Is it coming or is it going? And today I'm going to highlight why the answer is probably yes, and what do we do about it from a portfolio construction standpoint. And then again, our final theme definitely has played out year to date, perhaps got here a little bit more quickly than we had hoped, but volatility is definitely returning to center stage. And I want to help sort of frame why is that okay, historically what has happened in volatile environments, and what did we do about it from a portfolio construction standpoint as well. All right, so starting with the easiest theme, COVID moving from pandemic to endemic. I think the important thing to consider as an investor is when you look at this chart and you think back to 2020, initially we were dealing with what we're calling an unknown unknown. COVID emerges on the scene. We didn't know how bad it would be. We didn't know how contagious or how deadly it would be. And markets sold off really hard as the global economy shut down. But as we began to see the immediacy of the effects and what our ability to manage it was, confidence returned and markets quickly recovered. What we saw over subsequent waves is that the corrections got better and better and better as we began to anticipate and understand what steps were necessary to manage through it. So now as we are getting into the Omicron BA.2 variant, I guess is what we are at now, it is now an unknown or a known unknown in that we don't know when the next variant will come, but we have enough experience to date to know that we have the tools to manage it and that we have both the resources and the knowledge to effectively deal with the risk to our healthcare systems and prevent what had been feared as a total collapse back in 2020. And so it's more of a known unknown that we can't wait to get past, because I, for one, definitely in conversations and in just dealing with clients and people, I think there's a bit of fatigue setting in, and we're ready for the next thing. What's happened during the pandemic, though, has had a pretty remarkable impact on how we think about managing money. And one of the best ways to illustrate this is by looking at what's called a style war, or what the return difference are between growth stocks and value stocks. So in this chart on the left-hand side in light blue, what we're comparing are the absolute return differences between growth and value on a weekly basis. So if growth stocks generated 1%, value stocks generated 0%, that absolute return difference would be 1%. In 2018 and 2019, on a weekly basis, that was about 0.75%. But since the pandemic has started, that range has increased to 1.7%. This trend is similar across regions, across countries, across capitalizations, across sectors, and across industries. So while moving from pandemic to endemic is a great tagline, there are significant portfolio implications. One of those that I would encourage every client to consider is that the last 3 years have been incredible. Portfolios are ahead of where we would have expected them to be if we were having the same conversation 3 years ago. And so what are the implications? One of them is that we as your advisors and you as clients need to assess, how much risk do I need to be taking? Is this appropriate anymore, given the returns I have realized in my portfolios? And if it is, then we will continue to be your portfolio manager to help you understand and manage the risk within your portfolio. The second thing, and this ties a little bit into our next or our final theme around volatility, is that with expectations for higher volatility, given some of the effects that COVID has created within investment markets, is understanding what are the consequences of trying to time volatility. As volatility levels increase, making large portfolio shifts becomes costlier and costlier, particularly if they are emotional and driven around time to time strategic differences in portfolio allocations. And then finally, and this is probably the least obvious, but with volatility comes more and more opportunities to manage risk, which requires us as your advisors to be prepared for the implications around portfolio rebalancing, which we are. All right, so shifting more to the tightrope theme, and this is certainly something that is making headlines up until recently, with Russia sort of stealing some of those, but the narration or the narrative around what is the Fed going to do has been an increasing focus of investor attention year to date. In the upper left-hand chart, what we're illustrating with the light blue line is the money supply. In economic terms, it is called M2. Think about the balances in your checking accounts, your saving accounts, other cash deposits. That's what the light blue line is illustrating. The dark blue line is then illustrating the S&P 500 returns. And what you'll notice is that as the stair-step function of M2, money supply, expanded, there was a very positive and direct correlation with what happened to equity prices. So one must ask, what happens as this narrative or this policy initiative changes? It's something I am coining the great unwind, right? We've had all this policy stimulus come into place, and now investors are worried about or considering what are the implications of unwinding it. One of them, and it's another acronym that you may have heard, is this notion of TINA. TINA being there is no alternative. With a great amount of liquidity, investors were weighing their opportunities, and one of those opportunities was, do I sit in cash, do I buy bonds, or do I buy equities? And in reality, money went to all three of those places. But as that narrative changes, investors now need to become a little bit more focused on fundamentals, a little bit more focused on the earnings story, and incredibly focused on valuations, because that natural supply that was supportive of stocks, of all that money flowing into risk assets, is no longer going to be there. And then as we think about the Fed and their role that they've played in helping the US government and other central banks as well monetize debt, what are the implications within fixed income portfolios? So in the lower right-hand chart, or sorry, the lower left-hand chart, the blue line is illustrating the duration of the US aggregate bond index, which is representative of US credit markets and heavily dominated by US Treasury securities. The light blue line, conversely, is representing the payment that investors receive on it, or the yield or the coupon that one could expect to earn. Now, what's troubling about this graph is that as risk have increased, as interest rates have gone up, as leverage levels have gone up, the commensurate income that investors receive has remained fairly steady and in fact been suppressed by the behavior of the Fed expanding their balance sheet. And so as we think about what happens in this unwind, we want to be cognizant of how to best manage this risk. And a couple of the things we have really leaned into, and we've done this for years, and I think now is even a better time to refocus on it, is the use of active management. Investors can go out and you can buy the blue line, but the blue line is not paying you very well. And while it's cheap, it carries a tremendous amount of investment or interest rate risk. And so one thing we've done is really lean into active managers within the fixed income space. The other thing we've done is really assess what is our duration risk, or what's the interest rate risk within our portfolios, and how can we best position portfolios not to try and anticipate where interest rates will ultimately head up, but to try and anticipate the directionality of where interest rates are headed. One of the ways we've done that is give portions of our asset allocation more flexibility. So you've seen this introduced last year, where we added a strategic or a dynamic bond allocation to our portfolios. Part of the reason for that was recognizing the historic nature of where monetary policy was at and the implications it had on fixed income. And now that we're to the end of that policy period, this becomes an even more critical portion of our asset allocations. Apologies for the mouse. It is doing its own thing and going forward and backward on a whim. So All right, moving on to theme number 3. Is inflation coming or going? We would definitively answer the question as yes. And to help illustrate that, I've pulled in headline inflation using a chart that BlackRock published recently that reflects what happened with the December CPI figure. To help you become oriented to the chart, the orange lines reflect the weighting of each of the yellow components. And then the pink boxes at the very bottom highlight what are some of the unusual or rare features that has pretty significant impact in December's headline. And so when we think about inflation, there's really 2 ways to think about it. What is transitory and what is permanent? So to emphasize transitory, if you think back in 2020 at the start of the pandemic, oil had an incredible experience where for a brief period of time, the actual owners of oil, the people who own the mineral rights or who own the lease rights, were actually paying investors to take oil off of their hands. Oil futures were trading at a negative. Since then, we're now trading closer to $100 per barrel or on our way towards $100 per barrel with what's going on with Russia and Ukraine. That difference of going from a negative price to nearly $100 per barrel in about 18 months is really unlikely to repeat itself. And so we would label that as transitory. Now, similarly, the supply chain kinks or freezing that we've seen, particularly in semiconductors, has had an outside effect on asset classes or on components of CPI that don't otherwise historically have a meaningful impact. And that's most evident in used car prices. Last week, the Wall Street Journal did an analysis of vehicles that have been purchased with a model date of 2016 and later. And all of them, in general, are trading at a price higher than what they were originally purchased for. Now, I'm sure most of us have owned at least one, maybe more than one car. And I don't think any of us would say that used cars are an investment. And so again, when we think about the price appreciation or the inflation that we've seen in used cars, we see that as transitory because once semiconductor supplies normalize or unwind and become a little bit more fluid, we do not see this being a persistent increase. And for context, used cars made up about 20% of the CPI increase in December, which just should not happen and is very, very unlikely to repeat itself. However, there are a few components of inflation that are permanent. This chart is illustrating one of them, and the other is tied to wages. I'd like to start with wages. So when you think about the current labor environment, there's about 6.5 million people who are currently unemployed, about 4% of the workforce. But when you think about the opportunity set or positions that are waiting to be filled, there are currently more than 10 million jobs. It's about a 3.5 million difference between job openings and the people looking for them. And what that does is it creates an imbalance where those who want a job have an incredible amount of negotiating power, assuming they possess the skills and the mobility to fill the position. Ultimately, that puts upward pressure on wages. The thing about wages is that once people earn wages, they are rarely cut, except in the worst of times. And so given that our view is not anticipating a recession or something extremely severe, wages are likely to continue to put upward pressure on prices because people who earn more tend to spend more, invest more, and save more. And so you sort of have this trickle effect. One of the easiest ways that you can see this is in real estate, or within the CPI index, we call it owner's equivalent rent, which is on a monthly basis, a survey conducted of people who own homes that says, if you could rent your home tomorrow, what would you rent it for? Now, this data unfortunately lags home prices by about 3 to 4 quarters because homeowners don't initially believe in the opportunity set they're seeing in home prices. So taking an aggregate, there's a combination of events that are both transitory and likely to fade out, particularly as we get later into the year and base effects are reduced come March and April this year. But there are also effects that are likely to be with us for several quarters, which will continue to put upward pressure on inflation. Finally, volatility. I think one thing for certain that all investors have to do is be comfortable with where they're at with risk this year, because volatility is definitely going to be higher. While there are geopolitical events driving it, there's also the shift in fiscal policy that to date has been probably the leading factor of volatility, but then also how is growth going to adjust now that we are sort of through the initial thrust of an economic, of a business cycle where we've come through the early phases of it. A couple ways to think about this is that, again, reflect on 2020. Early on when the market crashed, there was a lot of concern about what does the future of the economy look like. And as we began to understand the unknown, investor confidence returned. And phase one was this broad acceptance that we had oversold. And so you saw prices increase without the support of earnings, which is what we call a multiple expansion. But then as consumers and governments gradually got more comfortable with it, companies began to generate more revenues, expand their margins, and ultimately were able to grow their earnings at an incredible rate. Almost 48% is what we're estimating for last year at this point. And so what you saw was you saw price appreciation within the S&P. You saw earnings outpace that price appreciation. So multiples ultimately remained fairly flat. But in the early portions of this, you had a tremendous amount of volatility. Now, for context, if we look back to 1983, most of the time there is an intra-year volatility or an intra-year drawdown of about 9%. For context, through last Monday, I didn't see where we closed today. I saw we were down. So I'm going to guess we're down about 9.5 or 10% year to date on the S&P 500. So we are right in that average range. More broadly, global markets are somewhere between 1 and 15% on the negative to start the year, but it's not entirely unusual. It's just that we have become conditioned perhaps over the last 3 years to not fully embrace this notion of volatility because we've been blessed with really, really good returns. So from a portfolio context, what we've done in thinking through, okay, if we anticipate higher volatility, what do we do about it from an asset allocation standpoint? And where most investors will see a change is that we leaned a little bit more into US equities. US earnings tend to be a little bit more stable than the rest of the world because we have some of the world's largest companies. And we're also a larger share of the world. So when you think about beta or your portfolio's exposure to global markets, having a broader exposure to US equities can actually dampen volatility. The other thing we did, and this is actually more risk management, is we maintained our target allocation to emerging markets. And this has to do with looking at what is the average cost or the average multiple on our portfolio. And by maintaining that target, we were actually able to bring it down because last year, China had a very difficult year. And you might recall that in 2020, China was the only global economy in the world to not go into a recession as a result of the pandemic. But that had a little bit of a payback in 2021, in addition to the regulations they introduced. And so now, on a relative basis, EM markets or emerging markets, which are about 35% Chinese equities, are really cheap. There's a lot of risk to them, but in the context of risk budgeting and understanding what the value of our portfolio should be and how we want to position it, we maintained that allocation. The other big adjustment we made in portfolios this quarter was within our real asset space. So again, what's the best way that we can position our portfolios to make sure that purchasing power is protected? And that was within real assets. We took a little bit of profits off the table in our real estate space, and we rolled that into our broader allocations of a diversified real asset fund that was introduced this year. All right, so turning to what has happened year to date, and what can we do to sort of help set expectations or reframe expectations to get clients through the end of the year? There's a common saying that as goes January, so goes the year. You may have heard of this. So I wanted to start off by sort of providing some context to that statement. And what I've done here is I've pulled together some data going back to 1926, which gives us quite a few reporting periods. And then starting on the left-hand side of this chart, we've had 58 years with a positive January. On average, those years have ended with a positive return of 12.5%. However, not all positive Januaries end with a positive year. In fact, about 21% of them end negative. So about a fifth of the time you can expect to have a negative calendar year return. Now, conversely, in the other 37 years, we had a negative January. And about 14 of those ultimately ended down, about twice the risk of a negative drawdown. But of those that did not, of the other 23 years, we had an 8.2% average return. The negative experience is more similar to what we've had recently. In fact, if you look at the last 13 years, going back to 2009, 7 of the 13 Januaries have had a negative year, but all have finished positive. So it's not to say that you should try and make an emotional decision, but it's context to certainly say the odds of ending up are significantly better than ending down. However, a negative year does about double the odds on a historical basis of 2022 potentially ending down. And we'll talk about why I don't think that is a problem, hopefully in the Q&A. Now, the other aspect that has certainly been troubling for markets year to date is what is going on with interest rates. Where are they headed? How fast can we expect that change to get there? So I wanted to provide a little context for investors because I have fielded a lot of questions on what's going on with the safest portion on my portfolio. Why are bonds having a difficult time? They don't appear to be playing the diversification role that we've hired them to be or that we've positioned them to be. And the reality is that the interest rate movements we've seen have been heavily concentrated at the short end of the curve, or the front end, the 3-month to 2-year portion of the Treasury curve. We've seen about 150 basis point move within the 2-year Treasuries, and that has all been entirely investors trying to anticipate where's the Fed ultimately headed as they think about what to do with inflation and how to maintain full employment. But here, what I'm trying to illustrate is that in rate hiking cycles, what's the average return experience of a bond holder over the next 12 months? And as you can see, on average, bonds tend to generate positive returns. It's one of the reasons we call them a safe haven or a safe asset within your portfolios. And sure enough, while we expect a Fed interest rate hiking cycle to begin in March, we don't necessarily expect that returns on bonds will be negative over the rest of the year. And there's a couple of reasons for that. Fundamentally, bonds pay a fixed coupon. Over time, that coupon is invested at higher and higher rates in a rate hiking cycle. And so your ability to recoup some of the potential price losses that were experienced short-term on the front end accelerates. But then there's also the maturing factor of the bond where you receive the par value or the principal back at maturity, which is then also subsequently reinvested at a higher rate. So in general, most rate hiking cycles return positive results at the end, though there has been periods of volatility, most recently in 1994, where not all bonds had a positive return during a rate hiking cycle. And with that, I'd like to turn it over to Q&A. Hopefully that stimulates a few questions that I can clarify any points that I may have missed.
Thank you, Keith, for all of this insightful information. Your wisdom and your expertise are certainly just such a valuable resource here at Cedar Cove and to each of our clients. For those of you that I have not had the pleasure of meeting, my name is Chris Sipe. I'm one of the founding partners here at Cedar Cove. As Keith said, the final component here of our presentation today will be the Q&A session. As Jen mentioned at the beginning, if you have any questions you'd like us to address, certainly use the Q&A function, which should be at the bottom of your screen within the Zoom window. You can just type your questions right in there to send our way and we'll monitor that. If you're not able to find the button, no problem at all. You can also send those questions via email to us. You can send those to team, T-E-A-M, @cedarcovewealth.com. And so a few of you did send questions ahead of time, so we'll certainly start with those, and then I'll just certainly monitor the Q&A section within Zoom to make sure we tackle any other questions that come up. And so Keith, like I said, we got a few questions that I'll start with here via email. The first one's just related to, and you addressed this a little bit, all of the market volatility that we've seen in January and so far here in February. How much longer do you expect volatility to continue, and what are the signs that we should look for to say that the market might be stabilizing?
Yeah, so I think volatility year to date, and I'm going to sort of carve out what's going on in Eastern Europe right now, but for the most part has been driven by monetary policy. And what we saw that sort of kicked off volatility was the release of the December Fed minutes in January, which was followed by a pretty surprising inflation number. Consensus that early on expected inflation to begin to slow down, but base effects, which in layman's terms is a comparison of year-over-year values. So in January, inflation was, I think, 1.25% at a headline. And so comparing January 2021 to January 2022 was a pretty big difference, and that caught markets by surprise. The minutes that came out from the Fed ultimately then said that the Fed was prepared to start tightening conditions much more quickly than investors had expected. And as a result, we saw positioning around credit and where we thought interest rates would go change pretty materially. And that's been a pretty significant factor that's both impacted credit markets and equity markets, because equities price off of treasuries because it's the risk-free rate that creates the discount rate, or is a variable within the discount rate that is ultimately used to price stocks. The other thing that I think all of us are trying to anticipate is to what extent is the economy slowing. One thing that has certainly happened as interest rates have been repriced is that the yield curve has flattened. One reason that's important is that historically the yield curve has served as a pretty good measure of when is the economy going into a recession. And so as that curve flattens, we get closer and closer into a slowing dynamic around a slowing economy. But there's a couple key things that I want to point out here and make sure everybody hears. We had an incredible amount of stimulus come into the economy. Around $5 trillion flowed in as a result of pandemic stimulus. Our total economy is around $22 trillion this year. And so when you think about a 25% stimulus to the economy, it's natural that the economy is going to slow coming out of that. And so while one of our themes is definitely around a slowing economy, which again is natural given the amount of stimulus we put into it, we by no means think the economy is going to stall. And we've seen that most recently in the current earnings season, where you've had just incredible growth. I mentioned this earlier, but 2021 earnings on a year-over-year basis on the S&P 500 are forecasted to grow about 48%. It doesn't get any better. But having said that, long-term, stocks price off of long-term trends in earning growth. And so in 2022, we're forecasting about 8.5%, 9% earnings growth. And so it's getting back to long-term averages, but there is a bit of an adjustment period going from a 48% annualized change to an 8.5% or 9% change. And certainly that has introduced some volatility in the markets. The other thing that I think futures markets, which is indicative of where do we think things are headed, that credit investors might be over anticipating is, to what extent will the Fed set a path and stick to it? And I think, at least for me and how we manage money, is that the Fed has been very transparent in their language, that their policy decisions are dynamic, meaning that they will use the latest information to make decisions. And so while there are firms on the street projecting 7, 8, 9 interest rate hikes, which would be pretty unprecedented, and ultimately probably push the yield curve into negative territory, the Fed is very much aware of those signals and very much aware of what happens when short-term rates exceed long-term growth. And I think you can anticipate that the Fed will slow down if they need to, if we begin to get to that area where short-term rates exceed long-term rates. Now, the other factor that has been weighing on investors, and sorry, this might be a little bit beyond the question, but certainly since last November, we've seen an acceleration in Russian activity along the Ukrainian border. Most recently, in the last 24 hours, we've seen a pretty aggressive push of peacekeeping Russian troops move into Ukraine. And as a result, you've seen sort of a united implementation of sanctions coming out of the US and out of the European Union. That is a very hard dynamic to predict. And when you think about volatility and when we'll get it better, it's hard to say. Historically, sort of these geopolitical events, markets get past them pretty quickly. If you think back to either 9/11 or Kuwait, markets sold off, I think in 9/11 was about 12%, 1994 was about 17%, but ultimately recovered pretty quickly. Most recently, when you think about a few smaller events like Crimea back in 2014, that was about a 3-week sell-off, and returns were recouped in about 3 weeks. So it was about 6 weeks complete round trip there. And I think there's a couple things that make it difficult to answer your question, Chris, is that Russia is a major exporter of energy. They make up about 11% of global oil. They make up 40% of exports to Europe. They're the largest exporter of wheat. They're a major exporter of aluminum. And so to the extent that global sanctions begin to tighten the ability for Russia to make some of these exports, you could begin to see some ripple effects in supply chains that are just in the very early stages of thawing. And so hard to anticipate how those play out, but those are certainly other variables that could put some upward pressure on prices. And ultimately, prices growing too fast would have a slowing effect on economic growth.
Thank you, Keith. Question just came in there. I think it's probably a follow-up question, so I'll just jump to that one and then get back to some of the other ones that were sent in ahead of time. So the question, Keith, is how is the U.S. no longer being energy independent impacting the economy?
No, you mean, read it again. No longer being energy independent or being energy independent?
The question is, how is the U.S. no longer being energy independent impacting the economy? Maybe there's a typo in there, I'm not sure.
Okay, so I think I know the guest was trying to ask. So a couple of years ago with fracking, the U.S. actually became energy independent, where the size of what we were able to produce exceeded what our actual daily demands were. And so the U.S. is actually in a position of independence. The challenge that the U.S. has faced since getting to that is that we haven't rapidly built out the infrastructure to manage what we're pulling out of the ground. And so we've had a few challenges being able to improve sort of our export capacity. However, there are a few new hubs that could come online, or that have come online actually last year and this year, that hopefully can stabilize or help Europe get through this crisis in the event that Russia were to shut off some of the fuel supplies that they provide to Russia. But I think U.S. energy independence in general actually puts us in a much better position, because we're not facing the same challenges that Europe is facing right now. Like I said, Russia provides Europe with 40% of its natural gas, and to the extent that Europe wants to lean on Russia with particular sanctions or with a military response, it would be pretty easy to turn off the gas to Europe. The US is not in that position presently.
Thank you, Keith. A few questions came in kind of all related to fixed income and bonds, and I know you addressed some of that earlier. So maybe I'll throw 3 questions at you all at once, Keith, and you can kind of answer all collectively. The first one just related to bonds in the portfolio. It says, I thought bonds were supposed to be safe. Can you share more about the volatility recently on my income portfolio? A second question or follow-up to that is inflation bad for conservative investors? And then finally, Keith, 2021 was not a great year for bonds, and 2022 is off to a rough start as well. With the Fed planning to raise rates, how quickly might we expect to see our bond portfolios improve, and to what degree?
Yeah, no, all good questions. I've certainly talked about this challenge with advisors quite a bit. So in my opinion, the worst is behind us, based on what we know, based on the latest economic data we've seen, based on where futures markets are pricing. The majority of pain within the fixed income market as it relates to Fed policy has already been realized. And so in terms of when can we expect things to get better, I think things are getting better. Every coupon we receive and we reinvest is being done so at a higher rate. I mean, yields on our portfolios in December were 2 to 4%, depending on the model you're in. Right now, they're running 3 to 5%. And so our ability to recoup some of the price declines is certainly faster. Now, having said that, it's important to acknowledge that what we've seen year to date has actually been worse than what we experienced back in the taper tantrum of 2015. And so there is a little bit of awareness for what's going on. But again, I think the biggest driver and the biggest thing to take away is that with how we manage money, we use what's called asset liability matching, so that within our income and distribution strategies, the front end of the portfolio is very, very aligned with the distribution needs. And so we typically hold 1 to 3 years in sort of this bullet share structure or in ultra short-term bonds to minimize the effects of what we've seen year to date. Now, having said that, the longer portions of our income and distribution buckets do have more exposure to what we've experienced today. But we as a team made some really important decisions last December that have helped us weather that pretty well so far for the year. And I would expect no different than what we've seen in previous hiking cycles, that on average, 12 months from now, our portfolios will be fully recouped. And in fact, in making some of the decisions, we do some historical back testing on what have some of the drawdown periods been and how long has it taken to recoup them. And we did that analysis in December. And I think importantly, key to our outlook is that the changes we've made within our fixed income portfolios assume that growth continues. They assume that the economy continues to expand, and there's no evidence to contradict that. And so to the extent that that happens, defaults remain low, spreads remain tight, credit remains a very, very safe and investable asset class. All we're seeing right now is simply an adjustment for interest rate expectations shifting as the Fed takes its foot off the gas.
Thanks, Keith. The next question or kind of theme I'll touch on here from the questions we're getting is related to something we've talked about in, I think, the past 2 to 3 webinars when we've done our economic updates. I know clients are super interested in ESG. And so just anything noteworthy about ESG since our last webinar is kind of the question, more of a broad question.
Yeah, so I can tell you a little bit about what myself and the team's been doing. So I'm in the process of pursuing an ESG designation that the CFA Institute is sponsoring. Actually take an exam on it next week. But the point in pursuing it is that it's really helped me gain a better understanding of what are the questions that I can reasonably expect to ask of the fund managers that we do due diligence on, and what are reasonable answers. As most of our clients know who are using ESG, this is a very dynamic and fast changing environment. And I think this is most evident in some of the world's largest asset managers. I like to use Larry Fink as an example. He writes an annual letter to CEOs. And the last several years, he has challenged CEOs to really focus on these different themes that underlie ES and G. And so certainly, as the world's largest institutional managers do this, I think we as smaller asset managers can glean some of the benefits that come from that. And particularly, it's through disclosures, it's through better reporting, it's through better transparency, and through being able to hold firms accountable to the sustainability reports they're putting out. It's an exciting time. I continue to believe that our ESG strategies will be the basis of our asset management philosophy, probably within the next 3 to 5 years, because it will just become the standard. through which all investors analyze their investments.
Wonderful. Thank you, Keith. Appreciate the updates there. We're excited about all of that. A couple more questions have come in. So unless there's any additional questions that trickle in, we'll kind of tackle these last two, and then hopefully everybody can get up to shovel their driveways here shortly. The second to last question, Keith, that came in is related to cryptocurrency, in this case, specifically Bitcoin. The question is specifically, Bitcoin was touted as a great hedge for inflation. Do you have any thoughts or comments as to why, during times of high inflation, are Bitcoin or other digital assets starting to lose ground? And what additional thoughts does Cedar Cove have regarding how we should view those types of digital assets?
Yeah, so it's a great question. I think there's two ways to think about it. One is that Bitcoin or the broader cryptocurrency sphere, like stocks in general, are somewhat of a forward-looking investment, meaning that their price really reflected inflation ahead of it actually getting there. So you saw inflation or you saw Bitcoin peak ahead of inflation actually reporting. So it did its job. What's changed is what were some of the factors driving inflation and how has the outlook for inflation changed? And so I've hinted at this a little bit, but certainly as the Fed takes its foot off the gas, as well as other central banks, and begins to apply the brakes, expectations around where inflation headed are for inflation to fall. And so to the extent that we think inflation will decline, the role of cryptocurrencies as an inflationary hedge should also decline with it. So the premium you're paying for that hedging aspect should fall, and we've certainly seen that. Now, that's looking at the space in isolation. There are certainly other factors playing into the crypto sphere. Won't jump into them, but for us as Cedar Cove, we still see it as an incredible technology that's very, very viable. And internally, we continue to work with both our custodian and our compliance team to help understand what could the potential benefits be and what are the potential risks that we need to be aware of if we are to introduce this as part of our portfolio mandate. Because I think it's an asset class that bears scrutinizing, because I think there's incredible potential within it, given the technology that underlies it.
Perfect. Thanks, Keith. The last question that has come in, hopefully I saved this question for the end, hoping you can leave us on a positive note. The question itself isn't super positive, but I'm hoping you can spin it around. We'll see. It says, it feels like all of the news outlets lately just have doom and gloom to report. Is anything good going on in the market nowadays? So I'll leave that last question for you, Keith.
Yeah, I mean, there's lots of good things. I think the easiest and lowest hanging fruit is I went to lunch today and didn't have to wear a mask. I mean, so we're getting close to the pandemic being behind us. And to the extent that the pandemic is moving into that endemic status and sort of taking on that flu status, it's no longer part of the conversation, and we can begin to focus our time and efforts elsewhere. I think other really important things from an economic standpoint are the employment market is really, really strong. It might not get enough attention, but I hinted at this earlier. There's a ton of job openings, and we're slowly beginning to see more and more people re-enter the workforce. And so you've got tons of opportunity to continue seeing employment drop and wages rise. And importantly, for those of you who think about or worry about inequality in this country or even across developed countries, right now we're seeing some of the greatest wage increases in some of the lowest earning percentiles of the workforce, which is great. It begins to pull in what has otherwise become a pretty disparate difference between the top and bottom. Other things that are good, I mentioned this earlier, but earnings are in a really, really strong position. Yes, they're more in trend with long-term growth, but there's nothing wrong with long-term growth trends. I mean, we can generate very positive returns over long periods of time with earnings growing at 8, 9, 10%, which is kind of where we expect them to be the next 2 to 3 years. I think other things that may have gotten lost in the details are there's an incredible amount of interest in infrastructure spending right now. Things like access to broadband technologies and improved safety on highways and roads and drinking water and things of that nature. Those are all very, very good things that will benefit us for years to come. So.
All right, thank you, Keith. For those of you who haven't had the opportunity to meet yet, my name is Nathan Knoll. I'm an advisor here. I want to say thank you for coming tonight. We are so grateful for the trust that you place in our team, and our goal is to help you have peace of mind, especially in these turbulent times. I want to say thank you again to Keith for the presentation. If any of you would like to connect with your advisor after tonight, know that we're just a phone call or an email away. Thanks again for coming. Have a great night.